In June 2026, OpenAI filed for an IPO, targeting a valuation of $850 billion. That number places a single software company above Walmart, Exxon, and JP Morgan Chase. In the year prior, that same company brought in $13 billion in revenue, while burning through $38 billion in expenses. When you break those numbers down to their unit economics, the gap is staggering. For every single dollar OpenAI earns right now, they lose $1.22. The fastest growing company in history is mathematically structured to burn capital faster than it can ever collect it. This massive deficit leads directly to a trail showing exactly who is profiting from OpenAI's losses. To understand how we got here, you have to look at what the founders were originally trying to prevent. In 2015, after Google proved its AI could conquer the game of Go, a group of Silicon Valley elites formed a nonprofit lab. Their goal was to prevent a single corporate monopoly from owning the future of intelligence. But the math of artificial intelligence is brutal. Training these models requires a staggering amount of specialized computing power, and those costs double every 3 to 4 months. By 2019, the nonprofit simply could not raise enough money to keep the servers running. With their runway collapsing, they turned to a corporation. By 2025, OpenAI was paying $17.2 billion in a single year to one entity, Microsoft. This created a perfectly closed financial loop. Microsoft invests billions of dollars into OpenAI, but that money doesn't sit in a treasury account. It immediately returns to Microsoft in the form of Azure Cloud Computing credits, effectively paying Microsoft to rent its own servers. This cycle allows Microsoft to report record-breaking cloud revenue growth to Wall Street, which in turn drives up its own stock price. The organization that promised to save humanity from corporate monopolies is now functioning as the most profitable R&D line item on Microsoft's balance sheet. The friction in this machine comes down to a metric called inference cost, the daily price of generating answers for the 800 million people actively using the platform. In typical software, adding more users increases your profit margins. Here, it does the opposite. Because inference requires heavy compute, every single new user actively accelerates the company's financial destruction. To survive that level of cash burn, the company requires continuous injections of capital. Raising that capital forces them into a relentless cycle of shipping consumer-facing products to keep investor hype alive. This creates a jarring public contradiction. The CEO has sat before Congress warning that artificial intelligence poses an extinction-level risk, yet the company continues to deploy new models faster than anyone else in the industry. Slowing down for rigorous safety testing would mean falling behind, which means the funding dries up. Competitive survival is now mathematically at odds with caution. In November 2023, the nonprofit board moved to fire their CEO because his commercial success had become a threat. In their view, the pace of product launches was no longer compatible with the safety of humanity. Within 5 days, intense pressure from Microsoft and internal staff forced a complete reversal. The CEO returned, and the board members with a legal duty to protect the nonprofit mission were permanently removed. Months later, the company announced a super alignment team to manage long-term risks, publicly promising them 20% of total computing resources. Internal reporting later revealed they actually received between 1 and 2%. The researchers in charge of that safety work resigned. When they left, they faced offboarding agreements threatening to claw back millions in vested equity if they refused to sign a lifetime non-disparagement clause. The internal guardrails were systematically stripped away to ensure the speed of deployment matched the demands of capital. By early 2026, the strategy began to fracture. For the first time, OpenAI lost its position as the enterprise market leader to its main rival, Anthropic. While OpenAI focused on building the largest possible general-purpose chatbot, Anthropic targeted the lucrative corporate market with specialized, regulated workflow tools. By mid-2026, Anthropic's coding agent had authored an estimated 4% of all public software commits globally. Desperate to feed their massive models, OpenAI's data collection practices grew aggressive. Internal teams actively bypassed Google's terms of service to scrape and transcribe over 1 million hours of proprietary YouTube videos. That decision carries an existential legal weight. If courts decide that unauthorized training data is not fair use, OpenAI faces billions in damages, and the potential court-ordered destruction of the models themselves. By focusing entirely on surviving the cost of computing power, they failed to build a defensible, legally secure business. The final defense from leadership is that superintelligent AI is inevitable, and therefore it is safest if the most responsible actor reaches it first. But a 1% compute allocation for safety research and a mass exodus of alignment experts directly challenges the claim that they remain that responsible actor. OpenAI failed to protect its founding mission because the financial architecture it chose to pay its server bills made any other outcome mathematically impossible. Next week, we are looking at Airbnb, a company built on the premise of democratizing travel, until you measure who actually owns the real estate and what happens when a residential neighborhood is efficiently, quietly hollowed out.